Welcome to the deep dive, where we really try to cut through all the noise and get to the insights that matter. Today, we're digging into something I find pretty fascinating. In a financial world that seems obsessed with getting bigger and bigger, how does a smaller niche player not just hang on, but actually, win? Is it about having every single product under the sun, or is it more about super focused, really high touch service for a very specific group? So our deep dive today focuses on Truxton Corporation. You might know the ticker TRUX. And look, this isn't just running through the basics of another financial company. We're really exploring a pretty unique business model here, one that's carved out a significant space in a really tough market, financial services, by zeroing in on high net worth clients. We've gone through a detailed investment research analysis on them, and our mission really is to pull out the most critical insights for you. We want you to understand what makes Truxton different, what its strengths are, the challenges too, of course, and why it's just such an interesting case study in specialized finance.
That's exactly right. Think of this as your shortcut to getting up to speed on Truxton. They're genuinely a distinctive player in wealth management. We'll unpack their strategy, how they position themselves, what really drives that, frankly, impressive success they've had. But we'll also look at the risks, the potential bumps in the road. The goal is to highlight why their approach seems to work so well and maybe what lessons we can draw from it.
Okay, so let's start at the beginning. Truxton Corporation, TRUX. It's a financial holding company, right? And it operates mainly through its subsidiary, Truxton Trust Company.
Correct. Founded back in 2004, based in Nashville, Tennessee.
Right, Nashville. But what jumps out immediately, and you mentioned this, is that even though they're based there, they apparently serve clients globally. That seems unusual for a firm of their size, doesn't it?
It really does. And that's where it gets compelling. The analysis we looked at keeps highlighting this idea of a distinct and defensible niche. Their entire focus, exclusive focus, is on high net worth HNW and ultra high net worth UHNW individuals. We're talking about wealthy families, their associated trusts, and the privately held businesses they often own. This isn't just a target market. It's like the core of their entire strategy.
So it's not just we prefer these clients, it's we only serve these clients.
Pretty much. And by specializing like that, they can offer this incredibly customized, high-touch service. Think about it. The giant banks, they have to build systems for millions of customers. They often work in silos. Truxton, because of its focus, can tailor its entire operation, the people, the processes, the tech, to the really complex, often very specific needs of wealthy clients. It allows for a much, much deeper level of engagement. It's about personalized solutions, not just selling standard products.
Okay, that makes sense. And this focus, this specialization, leads to what the analysis calls their synergistic ecosystem. Sounds fancy, but I guess it just means how the different parts of their business work together.
Exactly. It's the fundamental structure that lets them serve that elite client base so effectively. And it's built on three core pillars working together.
All right, let's break those down. What's pillar number one?
Pillar one, and you could argue it's the cornerstone, is wealth management. And this isn't just picking stocks. It's really comprehensive advice offered at a fiduciary level, meaning they're legally obligated to act in the client's best interest. So it covers investment management, sure, but also complex things like estate planning, trust advisory services, sophisticated tax strategies, planning for philanthropy, even full family office services for the ultra-wealthy.
Wow, that's broad.
It is. And the key thing here, the driver of that high-touch feel, is their operating model. Fewer clients per advisor. That's not just a talking point. It fundamentally changes the relationship. It allows for, incredibly deep personal attention. An advisor who really gets the whole picture, the family dynamics, the business succession plans, the multi-generational goals, not just the investment portfolio. That's the goal anyway.
Okay, so deep relationships, broad wealth advice. What's the second pillar?
The second pillar is private banking. And this fits hand in glove with the wealth advisory side. It's about providing highly tailored deposit accounts and lending solutions. Think customized deposit structures, maybe preferred rates, and what the analysis calls creative credit solutions. That suggests they're flexible, willing to structure loans against complex assets, or for unusual purposes, maybe bridge loans related to a business sale or something.
To stuff a regular bank might not touch.
Potentially, or at least not with the same integration, and it's all delivered with that same high-touch service. The idea is that a client's day-to-day banking needs, their borrowing, their cash management, it's all seamlessly integrated with their long-term wealth plan. You're not dealing with separate, disconnected departments.
Integrated. That seems to be the key word here. Okay, pillar 3.
Pillar 3 is capital advisors. This functions like a specialized boutique investment bank, but it's very focused specifically on family-owned and founder-led businesses, which fits perfectly with their H&W client base. Their main services here are consultative M&A advisory, particularly on the sell side, helping owners sell their companies. They also do exit planning, which is huge for business owners, recapitalization, succession planning, basically navigating that whole complex, often very emotional transition when a significant business asset changes hands or structure.
Right, so wealth management, private banking, capital advisors. Individually, they make sense. But you said the magic is in the synergy. How do these three actually work together in practice? You mentioned the capital advisors part. It's interesting. How so?
Yeah, this is where the model gets really clever, I think. The analysis points out that the capital advisors division acts as a strategic client acquisition engine for the whole firm. It's not just a separate service line.
How does that work?
Okay, picture this. Truxton's capital advisors team helps a longtime business owner sell their company. That transaction creates what the analysis calls a significant liquidity event. Suddenly, the owner has a lot of cash, potentially tens or hundreds of millions.
Right. Need somewhere to put it.
Exactly. And where does that money naturally flow? Straight into Truxton's own wealth management division for long-term investment strategy and portfolio management. And maybe a chunk goes into their private banking side for immediate liquidity, tax payments, maybe buying a new property.
Ah, I see. So the M&A work directly creates massive new AUM and deposits for the other divisions.
Precisely. It means Truxton can capture a client's entire financial life cycle, from advising them on growing and eventually selling their business to managing the resulting wealth for potentially multiple generations and handling all the sophisticated banking needs along the way. This creates incredibly strong, almost sticky client relationships. The trust built during a complex business sale is immense, and the switching costs become really high. It's not like just moving your checking account. It's unwinding this whole integrated financial ecosystem built around you.
That makes a ton of sense. It's a self-reinforcing model. Okay, so given the structure, how does Truxton actually make money? Is it mostly fees or interest or...
It's actually notably well diversified, which is a definite plus for a financial firm. They have a good balance between traditional banking income and fee-based revenue. So on one hand, you've got net interest income. That's the profit they make from the private banking side. The difference between the interest earned on loans and investments and the interest paid out on deposits. Pretty standard banking stuff. But then crucially, they have significant non-interest income. This comes from the fees charged by the wealth management division, typically based on assets under management, or AUM. It also includes trust service fees and, importantly, the advisory fees earned by the capital advisors division for those M&A deals and exit planning services.
And why is that balance good?
It provides resilience. Net interest income can be squeezed when interest rates fall or rise rapidly. Fee income from AUM is more sensitive to stock market levels. Having both helps smooth out the earnings stream and makes them less vulnerable to swings in either interest rates or market volatility. It adds stability.
Got it. Stability is good. Now back to Nashville. They're deeply rooted there, which is clearly a dynamic market, but they serve clients globally. How do they pull that off? How do they position themselves against the giants?
Well, Nashville is definitely a core strength. It's a very dynamic, affluent market, providing a strong local foundation. But reaching clients globally speaks volumes about their reputation and the specialized nature of their services. Their positioning isn't about being the biggest, it's about being the premier boutique. They compete explicitly on trust, deep expertise, and those really personalized relationships we've been talking about. They're not trying to outmuscle JP Morgan on scale.
So they lean into being small and specialized.
Exactly. The analysis mentions their founding principle was do the right thing. And apparently that's not just marketing fluff. It's positioned as a core competitive differentiator. For the kind of H&W and UH&W clients they serve, where trust and feeling like your advisor is truly on your side, that fiduciary duty is absolutely paramount, that resonates incredibly strongly. These clients often prioritize discretion, bespoke solutions, and that deep relationship over just getting the lowest possible fee or having the biggest global brand name on their statement. That allows them to attract and retain clients far beyond Nashville.
Okay, so that paints a pretty clear picture of Truxton's unique approach. But what about the world they operate in? Is the tide rising for private banking and wealth management overall? Are they in a growing sector?
Oh, absolutely. The market context is definitely favorable. The analysis cites some pretty big numbers. Globally, the private banking market was estimated around, $481 billion in 2023?
Hmm.
And it's projected to more than double, reaching over $1 trillion by 2031. That's a compound annual growth rate of about 10%.
$1 trillion. Wow.
Yeah, it's substantial. And even just looking at the U.S. market, it was around $109 billion in 2024, forecast to grow to over $180 billion by 2030. That's nearly 9% growth per year.
What's driving all that growth? Just more rich people.
That's part of it. Certainly the rising number of HNWIs and UHNWIs globally. But a really key driver is the increasing complexity of their financial lives. Wealthy clients today need sophisticated advice on a much wider range of issues, things like alternative investments, private equity, complex trust structures, cross-border tax planning. It's not just about managing stocks and bonds anymore. This growing complexity really plays into the hands of specialized firms like Truxton that are built to handle exactly that kind of intricate work.
Okay, so the overall market is growing and getting more complex. What specific trends are acting as tailwinds for Truxton's particular model? What's pushing them forward?
There are several big ones. First, as we touched on, is the demand for holistic, personalized advice. There's a clear shift happening. Clients, especially affluent ones, are moving away from just buying products from different places. They want to consolidate. They want one trusted advisor or firm who sees the whole picture and provides integrated solutions. Truxton's model is tailor-made for this trend.
Right, the integration again.
Exactly. Second, there's the massive demographic shift, often called the Great Wealth Transfer. We're talking about trillions of dollars. The analysis estimates over $72 trillion in the U.S. alone by 2045, passing from baby boomers to their heirs, mainly millennials and Gen Z.
And why is that an opportunity for Truxton? Won't the kids just stick with their parents' advisors?
Often no. Inheritors frequently seek out new advisors. They might have different priorities, maybe more interested in ESG or impact investing. They definitely expect more digital convenience, but still want that personalized experience. It's a huge pool of potential new clients for firms that can connect with that next generation.
Oh, okay, that makes sense.
What else? Third is the growing interest in alternative investments. H&W investors are putting more money into things like private equity, private credit, venture capital, specialized real estate funds. They're looking for diversification and potentially higher returns than traditional markets offer. This is a tailwind because managing these complex, illiquid assets requires real expertise sourcing deals, due diligence, administration. It demands sophisticated platforms, which raises the barrier to entry for smaller advisors, but creates opportunity for firms like Truxton that have or can build that capability.
So it helps them differentiate, but also requires investment.
Right. And fourth, there's the ongoing technological transformation. AI, data analytics, digital platforms, they're changing everything. For a firm like Truxton, technology isn't really about replacing advisors, it's about making them better. Automating routine tasks, providing better data insights for portfolio construction, enhancing cybersecurity, enabling more personalized communication. It frees up advisors to spend more time on the high-value, relationship-building, complex problem-solving work that their clients pay premium fees for.
Okay, lots of opportunities. But no industry is without its challenges. What are the big headwinds facing Truxton and its peers? What keeps them up at night?
Well, number one is probably intensifying regulatory scrutiny. Private banking and wealth management deal with large sums of money, complex cross-border flows, and sensitive client data. Regulators globally are constantly tightening the screws, especially around anti-money laundering, AML, and Know Your Customer, KYC rules, plus data privacy regulations like GDPR or state-level equivalents. Compliance isn't optional, and it requires huge ongoing investments in technology, processes, and people. It's a significant and growing cost burden, especially for smaller firms.
Right, the cost of doing business keeps going up.
Definitely. Second is plain old economic and market uncertainty. The industry is inherently cyclical. A recession can hit loan demand in the private bank, maybe lead to higher credit losses. Fluctuating interest rates, like we've seen recently, can compress net interest margins, NIMs, impacting banking profitability. And crucially, since so much revenue is tied to AUM, a prolonged bear market in stocks or bonds directly hits their fee income. They're very exposed to macroeconomic conditions.
Makes sense. Any other major headwinds?
Yeah, the third big one is industry consolidation. We're seeing a constant wave of M&A in asset and wealth management. Big firms are buying smaller ones to gain scale, acquire new capabilities, like those alternatives platforms we mentioned, or enter new markets. This creates sort of winner-takes-all, or at least scale matters dynamic. It puts pressure on mid-sized firms that don't have a truly differentiated niche. They risk getting squeezed out by the giants on one side and the nimble specialists on the other.
Which brings us to this concept. The analysis mentions the barbell market structure. This sounds really important for understanding Truxton's place. Can you explain that?
Yeah, this is a really insightful way to think about the industry's evolution. Imagine a barbell. On one end, you have the massive, mega-scale providers. Think Vanguard, BlackRock, Schwab, maybe. They offer low-cost, often passive, standardized products, increasingly digital-first, serving millions of customers efficiently. Scale is their game.
Okay, the low-cost giants.
Right. On the other end of the barbell, you have the high-touch, high-value boutiques. These are firms providing deeply personalized, bespoke advice and solutions for clients with really complex needs, often the H&W and UH&W segment. They compete on expertise, service, and relationships, not price.
And the middle gets squeezed.
That's the theory. The firms stuck in the middle, not big enough to compete on scale and cost, but not specialized or high-touch enough to command premium fees, are finding it tougher. And what's fascinating, according to the analysis, is that Truxton has deliberately and effectively positioned itself squarely at that specialized, service-oriented, high-value end of the barbell. Their entire model is built for that niche.
So they chose their spot carefully?
Very carefully. That niche is inherently less vulnerable to the fee compression and commoditization that's hitting the mass market end. But, and this is key, their success depends entirely on continuing to deliver that superior relationship-based experience that the mega firms, just because of their sheer scale and structure, find incredibly difficult to replicate consistently.
Okay, so they've picked their spot on the high end of the barbell, but even there it must be crowded. Who exactly are they competing against day to day?
It's definitely a fiercely competitive space, even within that niche. The analysis breaks down the competition into roughly 3 tiers.
All right, tier 1.
Tier 1, global financial institutions. These are the big household names, the private banking and wealth management divisions of the bulge bracket firms. Think J.P. Morgan Private Bank, Morgan Stanley Private Wealth Management, Merrill Private Wealth, Goldman Sachs, PWM. They compete on their global brand recognition, their massive capital markets access, huge range of proprietary products, international capabilities. And make no mistake, even though Truxton is in Nashville, these global giants have a significant presence there too, chasing the same wealthy clients.
Okay, the behemoths. Tier 2.
Tier 2, super regional and regional banks. These are large, often publicly traded banks with a strong footprint in Truxton's home turf, the southeastern U.S. The analysis mentions firms like Regions Financial, RF, and Synovus Financial, SNV, as examples. In many ways, these are arguably Truxton's most direct competitors. They often target similar client profiles, operate in the same geography, and offer a mix of banking and wealth services. The key difference is scale. These regionals are much larger than Truxton.
Right, bigger balance sheets, more branches maybe. And tier 3.
Tier 3, local and boutique competitors. This is a more fragmented group. It includes independent registered investment advisors, RIAs, multifamily offices, MFOs, and smaller community banks that might have a wealth division. In Nashville specifically, the analysis names examples like Woodmont Investment Counsel, Pinnacle Wealth Advisors, and David Adams Wealth Group. These firms compete intensely on deep local roots, community connections, and sometimes even more specialized niche expertise within the H&W space.
Wow, okay, so global giants, big regionals, local specialists. It's a tough crowd. Given all that, what exactly is Truxton's protective moat, as the analysis might put it? What really defends their business?
They've worked hard to cultivate some key advantages that are difficult for competitors, especially the larger ones, to copy effectively. The analysis highlights 3 main ones. First, and we keep coming back to this, is their fully integrated service model.
A synergy thing.
Exactly. It's called out as their key differentiator. The seamless knitting together of wealth management, private banking, and capital advisors under a single roof, often served by a unified relationship team. Think about that client selling their business again. At Truxton, theoretically, one core team understands the M&A deal, the investment plan for the proceeds, and the personal banking needs like a mortgage for a new vacation home. That cohesive approach, that deep understanding of the client's complete financial picture, is incredibly powerful.
Compared to being handed off between different departments at a big bank.
Precisely. Larger institutions, because of their size and structure, often struggle to deliver that truly coordinated, holistic service. Silos are almost inevitable at scale. Truxton's integration is a genuine structural advantage for the client experience.
Okay, integration is moat component number 1. What's number 2?
Number 2 is their fiduciary-centric, high-touch culture. This isn't just about saying the right things. It's embedded in how they operate. That model of fewer clients per advisor is crucial here. It allows for the time and focus to build those deep, trust-based relationships. Combine that structure with what the analysis calls their unwavering public commitment to a do-the-right-thing ethos, and you foster a culture where clients genuinely feel the advice is unbiased and in their best interest. For H&W clients wary of being sold products, this integrity is hugely valuable and creates a very sticky client base. They're less likely to leave over small stuff if they truly trust their advisor.
Trust as a competitive advantage. Makes sense. And the third component of the moat.
The third is their strategic niche focus. By only targeting H&W and UH&W clients, they can tailor everything, their service platform, their technology investments, their hiring and training, specifically to meet the complex needs of that demographic. They avoid what the analysis calls the distraction and resource dilution of trying to be all things to all people. This laser focus allows them to optimize their entire operation for their chosen clientele, becoming true specialists rather than generalists.
So focusing narrowly actually makes them stronger within that niche. Okay, putting it all together, the integration, the culture, the focus. What does this mean for their actual position in the market? Do they have significant market share? And can they charge premium prices because of this moat?
Well, on a national scale, their market share is, as the analysis is, negligible. They're a boutique firm, not a national player in terms of volume. However, within their core market, the H&W and UH&W community in Nashville and the Southeast, their position is likely substantial. They're a recognized name among their target clientele.
Then pricing.
Their pricing power comes directly from that moat. It's derived not from its products, which might be similar elsewhere, but from the perceived value of its advice and personalized service. Because clients value the integration, the trust, and the specialized expertise, Truxton can command premium fees compared to more commoditized offerings.
So they're not the cheapest, but they deliver value that clients are willing to pay for.
Exactly. However, the analysis is quick to point out the persistent threats. The sheer scale of the larger competitors means they can invest vastly more in technology and marketing. And the ongoing consolidation trend means the competitive landscape is always shifting. Their moat needs constant reinforcement.
And just quickly, the source material included a table comparing some financials, right? Anything stand out there?
Yes. Quantitatively, the most striking figure, which we'll dig into more, is Truxton's return on equity, ROE. The analysis pegs their normalized ROE at 21.01%. That number really jumps off the page compared to typical regional banks, which are often in the low to mid-teens. It strongly suggests their business model is fundamentally more profitable on an equity basis.
Okay, let's dive deeper into those numbers. But first, you mentioned something important earlier about the data itself. Truxton trades OTC, over the counter, not on the NYSE or NASDAQ. Why is that critical context before we talk financials?
It's really crucial for anyone analyzing the company. Because it's an OTC-traded entity, Truxton doesn't file the standard comprehensive reports with the Securities and Exchange Commission, the SEC, that exchange-listed companies do. We're talking about the detailed quarterly Form 10Q and the annual Form 10K.
And those are usually packed with information, right?
Exactly. Financial statements, management discussion and analysis, risk factors, executive compensation details, all standardized and rigorously reviewed. Without those SEC filings, our analysis has to rely on what Truxton does publish: its own annual reports on its website, its quarterly earnings press releases, and certain regulatory filings required for bank holding companies, like the Form FRY6 submitted to the Federal Reserve.
So what's the implication?
It means the overall level of public disclosure and, frankly, regulatory oversight is lower than for exchange-listed peers. The information is still useful, but it might lack the same granularity or standardization. It's just something important for any investor or analyst to understand upfront. You're working with slightly different, less regulated information set.
Got it. So bearing those limitations in mind, what do we know about Truxton's financial performance based on the available data? Has it been strong?
Yes. Despite the data nuances, the picture that emerges is one of a consistent track record of strong, profitable growth. The analysis highlights recent numbers. For instance, Q2 2025 net income attributable to common shareholders hit $5.3 million. That was an 18% jump from $4.5 million in Q2 2024.
That's pretty healthy growth.
It is. And diluted earnings per share, EPS, grew even faster, up 19% year over year from $1.55 to $1.84 in the same period. This kind of Robust bottom-line growth indicates successful execution of their strategy and suggests they're achieving effective operational leverage, meaning profits are growing faster than revenues or costs.
Okay, and you mentioned their profitability metrics earlier, particularly the ROE. Let's unpack that because it sounded really impressive.
Yeah, this is where Truxton really stands out financially. The profitability metrics are described as exceptionally strong. Morningstar data cited in the analysis shows a normalized return on equity, ROE, of 21.01% and a return on assets, ROA, of 2.00%.
And that 21% ROE, how unusual is that?
It's well above the typical low to mid-teens performance of most commercial banks. An ROE consistently above 20% is considered excellent in the banking sector.
So why is it so high? What's the driver?
It boils down to their business mix. A significant chunk of Truxton's revenue comes from its capital-light wealth management operations. Think about it. Generating fee income from managing assets, AUM, requires substantially less regulatory capital on the balance sheet compared to generating net interest income from making loans, which requires holding capital against potential loan losses.
So the wealth management side boosts the overall return on the equity they have.
Precisely. That fee-based, capital-light income stream structurally enhances the earnings relative to the equity and the ROE calculation. It makes their earnings inherently more capital efficient than a traditional bank that's mostly focused on lending. That's a huge structural advantage for profitability.
Okay, high profitability. What about the overall size and cash flow?
The balance sheet has shown steady growth, reaching around $1 billion in total assets in 2024, according to the analysis. And while detailed cash flow statements aren't as readily available as for SEC filers, their consistent history of dividend payments and share repurchase programs serves as strong indirect evidence of strong and reliable cash flow generation. You can't consistently return cash to shareholders unless you're generating it reliably.
Right, that makes sense. So they've got a strong track record. How do they plan to keep the growth engine running? What are the key strategies?
They seem to have a multi-pronged approach, focusing on sustainable growth rather than just chasing size. The primary engine appears to be organic growth.
Meaning growing the existing business?
Yes, mainly through two levers. First, recruitment, development, and retention of high-quality advisory talent. The analysis notes press releases about promotions and new hires, suggesting they're investing in their people to handle more clients and complexity. Second, deepening relationships with existing clients, using that integrated model to capture a larger share of wallet from the clients they already have, selling more services to existing happy clients.
Okay, organic growth first. What else?
Second is geographic expansion, but pursued very carefully. The analysis calls it deliberate and methodical. They cite the recent establishment of a presence in Georgia with some key hires there as a prime example.
So testing the waters outside Tennessee.
Exactly. This move into Georgia is seen as a critical test of the business model's scalability. Can they replicate that unique Truxton culture, that high-touch service, that integrated approach in a new market? Its success or failure will tell us a lot about their potential long-term total addressable market.
A key thing to watch then. And the third growth driver.
The third one goes back to that clever synergy we discussed. Inorganic growth through capital advisory. The analysis reiterates how this division acts as a unique and powerful growth catalyst. By advising business owners on M&A deals and other liquidity events, it effectively creates a pipeline of new high-value clients for the wealth management and private banking sides. They are, in effect, creating their own future AUM growth opportunities.
So it's not just organic growth or geographic expansion, but this built-in mechanism for bringing in large new clients.
Correct. It's a really interesting and somewhat unique growth flywheel they've built.
So summing up management strategy, it sounds like it's about sticking to their knitting, but doing it really well and expanding carefully.
That seems to be the essence of it. The strategy appears centered on disciplined, profitable growth within their defined H&W niche. They're leveraging their strong brand reputation and service model, capitalizing on those favorable demographic trends, especially in the Southeast, but without chasing growth at the expense of profitability or culture.
Now let's talk about something investors always care about, getting paid. How does Truxton handle returning capital to its shareholders? What's their approach?
Their approach is described very positively in the analysis as a clear, consistent, and highly shareholder-friendly capital allocation policy. They don't just let cash pile up. They have a deliberate strategy for returning excess capital to the owners of the business.
And doing that consistently signals confidence, right?
Absolutely. A predictable and growing return of capital signals confidence from management in the stability and future growth prospects of the company's earnings. It suggests they believe they can fund their growth needs and still have cash left over for shareholders.
So what are the actual ways they return this capital? What are the components of this policy?
It's a multi-pronged approach, giving them flexibility. First, there are regular quarterly dividends. They have a stated policy of paying these, and the analysis notes a recent declaration of 50 cents per common share for Q3 2025. It provides that steady income stream investors like.
Okay, regular payouts.
Second, importantly, there's a history of dividend growth. Management hasn't just maintained the dividend, they have a proven track record of increasing it. The analysis mentions an increase announced in January 2025. Raising the dividend regularly is a strong signal about their positive outlook on future cash flows and a real commitment to growing shareholder returns over time.
Growing dividends are always nice. What else?
Third, they sometimes use special dividends. On top of the regular quarterly ones, if earnings are particularly strong or capital levels are comfortably high, they've shown a willingness to pay out extra cash as a special one-off dividend. The analysis cites an example in January 2025. This shows flexibility and a focus on returning capital when prudent.
So regular, growing, and sometimes extra dividends. Anything else?
Yes, the fourth tool is active share repurchase programs. Buying back company stock is another direct way to return capital. It reduces the number of shares outstanding, which boosts earnings per share, EPS, for the remaining shareholders, and can help support the stock price. The analysis notes a new $5 million buyback authorization announced in January 2025.
Okay, that's quite a comprehensive toolkit. Regular dividends, growing dividends, special dividends, and buybacks. You mentioned earlier this is especially important given their OTC status. Why is that link so critical?
It's a really key strategic point. Remember the challenges of being an OTC-listed stock.
Yeah.
Potentially lower trading liquidity, less visibility among investors, and crucially, a much smaller pool of potential institutional investors, because many big funds have rules against owning OTC stocks.
Right, the big money often can't buy it.
Exactly. So how do you attract and retain investors in that environment? By offering a robust and growing dividend. Truxton's current dividend yield, cited at around 3.7%, provides a compelling value proposition, especially for income-oriented investors. It generates a tangible, predictable return. This strategy helps create a stable source of demand for the stock, compensating investors for those structural disadvantages of an OTC listing, like lower liquidity. It helps support a fair valuation for the company. In essence, Truxton is using its capital allocation policy not just to reward shareholders, but as a sophisticated strategic tool for managing its shareholder base, given its listing situation.
That's smart, turning a potential negative into a reason to invest. What about the other side of the balance sheet debt? Do we know much about their financial prudence there?
Detailed debt schedules aren't typically found in the press releases or summary annual reports they provide, unlike an ended 10K. However, the crucial point is their status as a bank holding company. This means they are subject to regulatory capital requirements overseen by the Federal Reserve and state banking authorities. These regulations mandate minimum capital ratios, effectively limiting how much leverage they can take on relative to their assets and risk profile. This inherent regulatory oversight promotes a certain level of prudence in financial management. They can't just load up on debt without attracting regulator attention.
Okay, we've talked about the model, the market, the financials. Let's talk about the people. How do we gauge the quality of Truxton's leadership team, especially, again, without those detailed SEC filings like proxy statements that usually profile executives and directors?
It's definitely more inferential than having a detailed proxy statement. But the available evidence, according to the analysis, points towards a highly effective and strategically adept leadership team. You have to judge them primarily by their results.
What results stand out?
Well, the things they've already discussed. Their consistent track record of profitable growth, that industry-leading return on equity, achieving over 21% ROE isn't accidental, and those disciplined, shareholder-friendly capital allocation policies, these are all strong indicators of sound management and operational excellence. Beyond the numbers, the analysis suggests that the very strategic design of the integrated business model itself points to a leadership team with a clear and sophisticated long-term vision. They didn't stumble into this structure. It seems carefully crafted.
And recent actions.
Recent announcements about internal promotions, grooming talent from within, and bringing in new people specifically for that geographic expansion into Georgia also suggest a management team focused on human capital development and sustainable growth, not just short-term gains.
Okay, so the leadership seems strong based on performance. What about corporate governance, the board of directors, their oversight role?
Again, information is less detailed than for an SEC filer, but the analysis suggests the board appears actively engaged in its oversight role. A positive sign noted is the appointment of new directors Danielle Barnes and Charles Mueller were mentioned as joining in late 2024 and early 2025. Bringing in new directors periodically suggests a commitment to refreshing the board with new perspectives and expertise, which is generally seen as good governance. For the nitty-gritty details on board composition, director independence, and committee structures, the key public document would be that Form FRY6, the annual report filed at the Federal Reserve. That's where you'd look for more governance detail on a bank holding company like this.
Right, the FRY6. And how does Truxton actually communicate with its shareholders? How transparent are they, given the OTC context?
Communication primarily happens through their regular press releases. They seem quite consistent in announcing quarterly earnings results, dividend declarations, buyback authorizations, key hires, and other events deemed material.
But it's less comprehensive than what you'd get from, say, Apple or Microsoft.
Oh, definitely. The analysis emphasizes that the overall level of transparency is lower than that of exchange-listed peers. Those companies typically host quarterly earnings conference calls where analysts can ask detailed questions, and they file those exhaustive 10Q and 10K reports. Truxton doesn't do the analyst calls, and their self-published reports are less standardized and detailed. It's just a structural difference tied to being OTC and not filing with the SEC.
Okay, which leads to a really interesting question you touched on earlier. Who actually owns Truxton stock? If institutions mostly can't buy it, what does the ownership base look like?
This is highlighted in the analysis as a significant characteristic and offers a really potent insight into the company. Institutional ownership, meaning ownership by mutual funds, pension funds, endowments, etc., is reported as exceptionally low at just 0.29%.
0.29%, that's tiny.
It's incredibly low. The remaining 99.71% is classified broadly as public and other. And the analysis states this is a direct consequence of Truxton's OTC-traded status and its decision not to file with the SEC. As we said, the investment mandates of many, if not most, institutional investors simply preclude them from owning securities like this.
So what does that imply about who the typical TRUX shareholder is?
It structurally limits the potential buyer pool, for sure. The strong suggestion from the analysis is that the current shareholder base is likely composed of company insiders, employees, and local high-net-worth clients who have a deep first-hand understanding of the business. People who know the management, use the services, live in the community, and believe in the model based on direct experience rather than just screening quant factors.
So a stable, knowledgeable, maybe very loyal shareholder base.
Likely so. But while that stability is a positive, the flip side is that this limited pool highlights a major potential upside catalyst. The analysis explicitly states that a potential future uplisting to a major exchange like the NASDAQ or NYSE could serve as a major catalyst.
Why would uplisting be such a big deal?
Because it would instantly open the door to that vastly larger universe of institutional investors who currently can't buy the stock. Access to mutual funds, ETFs, pension funds could dramatically increase demand for the shares, likely leading to improved liquidity and potentially a significant re-rating of its valuation multiple as it gets compared more directly to exchange-listed peers with similar growth and profitability profiles. It could unlock a lot of value.
Okay, we've explored the potential upside and the strengths, but every investment, every company has risks. We touched on industry headwinds earlier, but what are the specific risks tied directly to Truxton's business model and situation?
Absolutely crucial to understand the downsides.
Yeah.
The analysis identifies several company-specific risks. First and foremost, given their model, is key person and advisor retention risk.
Because it's built on relationships.
Exactly. As a boutique firm where deep personal relationships are paramount, Truxton is heavily dependent on his key senior advisors. If a few prominent, well-respected wealth advisors were to leave, especially if they took a significant chunk of their clients with them, it could lead to significant client attrition and a corresponding decline in assets under management that would directly hit their recurring fee revenue hard.
So keeping top talent happy is critical. What else?
Second are concentration risks, really in two forms. First, client concentration. Their exclusive focus on HNW clients makes their revenue potentially highly sensitive to economic downturns that might disproportionately affect the spending, borrowing, or investment appetite of this specific demographic. Second, geographic concentration. While they have global clients, their core operations and a large part of their client base are still rooted in Nashville and the southeastern U.S. This makes them somewhat vulnerable to a regional economic slowdown if that area were to underperform the national economy.
Okay, reliance on key people, wealthy clients in the Southeast. Any other big ones?
Yes. Third is the ongoing competitive and scale disadvantage. We discussed the competitors they operate in a fiercely competitive industry against global and regional financial institutions that have vastly greater financial resources, much larger balance sheets, bigger marketing budgets, and significantly more money to pour into technology development. While Truxton's niche provides some insulation, they are constantly fighting against players with enormous scale advantages.
It's David versus Goliath in a way.
In some respects, yes. And fourth, like any financial institution, they face operational risks. This includes the potential for fraud, internal or external, transaction errors, failures in internal controls, or systems outages. As they expand geographically, managing these operational risks across multiple locations adds complexity.
Okay, those are company specific. What about the broader macro and industry risks that could impact them?
These are significant too. We touched on some earlier, but to reiterate, market risk and economic sensitivity is huge. A big chunk of their revenue is tied to AUM levels. So a severe or prolonged downturn in equity and bond markets would reduce AUM and, consequently, fee-based revenues. Simple as that. A broader recession could also lead to increased credit losses in their loan portfolio and certainly reduce demand for M&A advisory services from the Capital Advisors Group.
So they're very exposed to market cycles.
Very much so. Then there's interest rate risk. The profitability of the private banking side is sensitive to shifts in interest rates. Rapidly rising or falling rates can compress their net interest margin, NIM, the spread between loan yields and deposit costs, which directly impacts earnings. Managing this risk is a core banking function, but it's always a factor.
Right, regulation.
Regulatory and compliance risk is ever-present and likely increasing. They're subject to a complex web of banking and investment advisory regulations, which are constantly evolving. Think about things like the proposed Basel III endgame capital rules, ongoing consumer protection-focused data privacy rules. Compliance costs are significant and only going up, and any misstep can lead to hefty fines and serious reputational damage.
And the one everyone worries about now.
Cybersecurity risk. For any financial institution, but especially one built on trust and handling the sensitive data of wealthy clients, this is a paramount threat. A successful cyber attack, whether it's data theft, ransomware, or operational disruption, could be catastrophic. It could lead to direct financial losses, regulatory penalties, lawsuits, and perhaps most damagingly, severe, long-lasting damage to the company's reputation as a trusted steward of client assets. Recovering from that kind of breach would be incredibly difficult.
Okay, we've weighed the strengths, the growth drivers, the risks. Now, let's try to bring it together from an investment perspective. How should we think about valuing Truxton Corporation? What's the framework?
Valuing Truxton is definitely not straightforward. You can't just slap a generic bank multiple on it. The analysis stresses that its valuation must consider the interplay of several key factors. Its superior profitability metrics, especially that high ROE, its distinct niche market position and integrated model, and critically, those structural factors related to its OTC listing, like lower liquidity and transparency.
So it's a balancing act in the valuation. What are the actual numbers looking like right now based on the analysis from late July 2025 when the share price was around $81?
Okay, based on that $81 share price and roughly 2.88 million shares outstanding, the market capitalization works out to approximately $230 million. Pretty small cap. Using the trailing 12 months TTM earnings per share, EPS, of $6.61 cited in the analysis, the price-to-earnings PE ratio comes in at 12.10x. And importantly, given our discussion on capital allocation, the forward dividend yield, based on an anticipated annual dividend of $3 per share, or if it be regular quarterly plus the expectation based on past special dividends perhaps, though the analysis is explicit about the $1.52 quarterly, is estimated at approximately 3.7%. That provides a substantial income component to the potential return.
Okay, a PE around 12, yield around 3.7%. How does that stack up historically or against its peers?
Well, the analysis notes the stock's 52-week range was $64.75 to $82.85. So at 81.1 is trading near the upper end of that range, suggesting strong recent performance and positive investor sentiment leading into late July 2025. Now, comparing it to peers is where the nuance comes in. That high ROE, over 21%, strongly suggests that it should command a premium valuation compared to typical regional banks, whose ROEs, as we said, are often much lower, maybe 10-14%.
Does the market seem to be giving it that premium?
To some extent, yes. Its PE of 12.0x is at the higher end of, or maybe slightly above, an illustrative peer PE range of 10 by 12x mentioned in the analysis. And its dividend yield of 3.7% is certainly competitive within a typical peer range of 2.5%, 4.0%. So the market appears to recognize some of its superior quality. But the key question for an investor, as the analysis frames it, is whether that current multiple fully reflects this advantage. The high ROE, the capital-light model, the growth prospects, especially when weighed against the OTC listing discounts.
Right. So fundamentally, forgetting the multiples for a second, what are the real underlying drivers of Truxton's intrinsic value? What makes the business worth what it is?
From a fundamental valuation perspective, it boils down to a few key drivers. First, and probably most important for the long term, is AUM growth. Their ability to consistently attract net new assets into the wealth management arm is the primary driver of long-term growth in its high-margin fee business. Second, clearly, is market performance. Since a big slice of revenue is AUM-based fees, the overall direction of stock and bond markets directly impacts revenue and earnings. Third, for the banking side, net interest margin instability is crucial. How well they manage the spread between loan yields and deposit costs affects a significant portion of their income. And fourth is operational leverage. As they grow, can they control costs and become even more profitable? Can revenue growth translate efficiently into bottom-line growth? The conclusion from the analysis is that the high-quality, recurring nature of its fee-based revenue and its superior ROE would likely justify a lower discount rate and a higher terminal value multiple in a discounted cash flow model compared to a traditional bank primarily focused on lending. So the valuation should reflect a premium for its capital-light business mix and strong profitability. But that premium might be potentially offset by a discount for its limited liquidity and lower transparency as an OTC-traded company. It's that push and pull.
Okay, let's synthesize everything we've discussed into the core arguments for and against Truxton as an investment concept. What's the bull case? Why would someone be optimistic?
The bull case really leads into the quality and positioning of the business. First, it emphasizes the superior niche business model. The argument is that Truxton operates a highly profitable integrated platform with a genuine defensible moat built on that high-touch service, deep trust, and the synergistic structure that's hard to replicate. Second, bulls would point out that Truxton is positioned for secular growth. It's right in the path of powerful tailwinds like the great wealth transfer and the increasing demand from H&W clients for exactly the kind of holistic, personalized advice that Truxton specializes in. Third is the financial performance, exceptional profitability, and shareholder focus. That industry-leading ROE isn't a fluke, it's structural. And management has clearly shown a proven commitment to returning capital to shareholders through those growing dividends and buybacks. It's managed for shareholder value. And fourth, don't underestimate the strategic geographic position. Being headquartered in Nashville, one of the country's most economically vibrant and fastest-growing metro areas, provides a rich, expanding pool of potential H&W clients right on their doorstep. So the bull thesis is essentially that for investors willing to look past the OTC listing and do their homework, TRUX offers a high-quality, shareholder-focused compounder, operating in a very attractive industry niche and geographic market.
That sounds like a compelling story. But there are always two sides. What's the bear case? What are the strongest counter-arguments or reasons for caution?
The bear case focuses on the challenges and inherent vulnerabilities. First, bears would hammer on the intense competition and scale disadvantage. Truxton competes against behemoths with vastly deeper pockets, stronger brand recognition globally, and much larger tech budgets. Can they really keep winning against that onslaught long-term? Second is the high economic and market sensitivity. We talked about this. Their revenue and earnings are tightly linked to financial market performance and the fortunes of their concentrated H&W client base. A recession or a prolonged bear market could hit them particularly hard. They lack the diversification of a massive universal bank. Third are concerns around scalability and key person risk. Can that boutique, relationship-driven model truly be scaled effectively into new markets without diluting the culture that makes it successful? And what happens if a few of those critical relationship-holding senior advisors decide to leave? The business relies heavily on a small group of key people. And finally, the bears would absolutely emphasize the limited liquidity and transparency due to the OTC stock listing.
The lack of standard SEC filings inherently limits the potential investor base, keeps most institutional money out, and could lead to a persistent valuation discount and higher stock price volatility compared to listed peers. It's a structural impediment.
So bulls see quality and niche dominance. Bears see scale challenges and structural limitations. For someone tracking Truxton, what are the key things to watch going forward? What are the potential catalysts or milestones that could significantly change the story?
The analysis points to a few crucial things to monitor. First, and this is the big one, is any movement towards uplisting to a major exchange. A decision to list on the Nasdaq or NYSE would be, as the analysis states, a transformative catalyst. It would instantly broaden the investor audience and likely trigger a significant re-rating of its valuation multiple. That's catalyst number one.
Okay, uplisting potential. What else?
Second, keep a close eye on the performance of geographic expansion. How well does that move into Georgia actually perform? Do they announce further expansion? Success here would be a critical indicator of the model's scalability and proof of management's execution ability outside their home turf. Failure would raise serious questions. Third, watch the fundamental driver, AUM and net new asset growth. Is the wealth management business continuing to attract net inflows of client money? Consistently strong growth here, especially if achieved even during periods of market volatility, would powerfully validate their value proposition and client loyalty. And finally, continue to monitor their capital allocation announcements. Are the dividend increases continuing? Are they renewing or utilizing share repurchase authorizations? These remain key signals of management's ongoing confidence in the business and their commitment to delivering shareholder returns.
We've covered an immense amount of detail today. Just to wrap up on process, can you quickly recap where all this information came from? What were the sources for this deep dive?
Sure. It's always good to be clear on the sources. This analysis, as we've mentioned, was compiled using publicly available information. The primary sources were materials directly from Truxton Corporation. That includes their investor relations website, where we found their self-published annual reports for 2024 and 2025, plus numerous press releases covering quarterly earnings, dividend news, appointments, and things like that, up through late July 2025. We also referenced specific regulatory filings, primarily the annual report of holding companies that form FRY6, which bank holding companies file with the Fed.
So company materials and bank filings, did you use anything else?
Yes. To get broader context, comparative data points, and industry trends, we looked at third-party sources. This included reputable financial data providers like Seeking Alpha, Morningstar, where that ROE figure came from, and NASDAQ for stock data. For the bigger picture on wealth management and private banking trends, things like the Great Wealth Transfer or the growth forecasts, the analysis drew on research reports and industry surveys from well-regarded firms like PwC, McKinsey & Company, Natixis Investment Managers, and MSCI.
But it's crucial to remember the limitation we discussed.
Absolutely critical.
Yeah.
We have to reiterate that because Truxton trades OTC and doesn't file standard SEC reports, 10Ks, 10Qs, the depth and standardization of the information are different. We relied heavily on their self-published materials and specific bank regulatory filings. This inherently represents a lower level of disclosure and regulatory oversight compared to an exchange-listed company. So areas like very detailed segment profitability, granular breakdowns of executive compensation, or the specific terms of their debt might require more digging or ongoing monitoring than what was readily available in the source materials used for this analysis. And of course, everything is based on information available as of July 28, 2025, and things can always change.
That's a great summary of the sources and the context. Thank you. Pulling this all together, the real aha moment for me in this deep dive is seeing Truxton as this powerful case study. It shows how a really focused, tightly integrated, genuinely high-touch model can carve out a successful niche and thrive, even when up against competitors with seemingly infinite resources. It proves that in specialized finance, sometimes precision and focus can beat sheer mass.
I agree. What's truly fascinating, I think, is that Truxton's story really suggests that sometimes the real competitive advantage, the true value, isn't found in being the biggest player on the field. It's about being demonstrably the best at serving a very specific, very complex need for a defined group of clients. And the ongoing challenge, the tightrope they have to walk, is figuring out how you scale that kind of excellence, how you grow without diluting the very essence, that culture, that integration, that trust that made you special in the first place. That's the puzzle they and firms like them constantly have to solve.
That is the puzzle. And it leaves us with a really interesting thought to chew on. What other industries, maybe completely outside of finance, could benefit from a similar strategy? Where else could deep integration and a laser focus on a specific demanding niche outperform a more generalized approach? Thinking about these different strategic models, understanding these nuances, that's what helps make you well-informed. Thank you for diving deep with us today on Truxton Corporation. Keep learning, keep asking questions, and we'll catch you on the next deep dive.